focused on new developments and training. And my name's Matt Wadley, and I head up our business development efforts here in North America. I've got about 30 years experience in the legal and financial services industries, most recently in professional services and software solutions. And I'm joined today by Sam Gibbins, who's our General Manager for Asia. Sam is a frequent speaker and a thought leader on regulatory issues in his market. So today's webinar is broadly around new developments in AML and specifically how you can meet your training requirements in this area. I'm just going to go through an agenda for us today. We're going to talk about the new rules for investment advisors here in the US. In this section, we're going to look at these rules that have been proposed for investment advisors and what they mean from a training standpoint generally. In this section of AML training, tailoring your AML training solutions, we're going to look at how you can specifically set up a training regimen to meet the different needs of your business according to its size, activities, and risk profile. We're then going to talk about cybersecurity and AML. We're going to look at the connection between those two and discuss how training should incorporate aspects of cybersecurity given the increased focus on that area of late. And finally, just to talk about questions and how we'll do that, if you want to put your hand up and ask a question, we'd be happy to field it during the presentation. We'll also have time for questions at the end. So in each of these sections that we'll cover, we want to show you some practical illustrations or demonstrations of suitable training solutions and techniques. Any questions from anyone before we get going? Okay, let's talk about our first topic, new rules for investment advisors. So obviously, this has all come about from the announcement from FinCEN in August 2015. On the 25th of August, as you're all no doubt aware, FinCEN proposed a rule requiring certain investment advisors to establish AML programs and report suspicious activity to FinCEN pursuant to the Bank Secrecy Act. FinCEN proposed to include investment advisors in the general definition of financial institution, which, among other things, would require them to file currency transaction reports, suspicious activity reports, and keep records relating to the transmittal of funds. So the rule, or the proposed rule, talks about applying to investment advisors who are required to be registered with the SEC, and that's generally those with 100 million more in assets under management. And it includes advisors to certain hedge funds, private equity funds, and other private funds. However, what's interesting is that FinCEN also indicated it may consider a future expansion to include investment advisors who are not registered or required to be registered with the SEC. So anyone with any kind of assets under management who's a licensed investment advisor could potentially be included in this. Basically, the rules propose the establishment of AML programs, including training. So specifically under the proposed rule, registered investment advisors are to be treated as financial institutions under the Bank Secrecy Act and the USA Patriot Act. The proposed rule requires registered investment advisors to implement an AML program with certain core features, including written policies and procedures reasonably designed to prevent the advisor from being used for money laundering or terrorist financing, periodic independent testing of the program, designation of people responsible for monitoring the operations and internal controls of the program, and specifically, and what we're sort of focused on today, is ongoing training of appropriate personnel. So I'll come back to training specifics in a few moments. But some of the other things that were called for, as I alluded to, were reporting obligations. So In addition, the proposed rule includes those investment advisors in the definition of financial institution, which means it imposes reporting obligations such as the need to file suspicious activity reports, currency transaction reports, and keep records relating, as I said earlier, to the transmission of funds. The examinations under the rules, FinCEN is going to delegate its authority to examine investment advisors for compliance with these requirements to the SEC. FinCEN believes that with the current obligations already faced by advisors and monitored by the SEC, the overall regulatory burden is not going to be significantly increased. That's their opinion. A lot of people have a different opinion, obviously, to that. Importantly, the proposed rules called for the program to be tailored according to the risk faced by the institution. So, it recognizes that different types of investment advisors may present varying degrees of money laundering and terrorist financing risks. So it anticipates that the burden of establishing an AML program would also correspondingly be reduced due to the risk-based nature of the program and types of advisory services these entities provide. So in other words, a lot of investment advisors, through their activities and through their structure and through the way they conduct their business, are going to provide a low risk, and the AML program should be tailored accordingly. So let's talk about specifically what the rules talk about with respect to training. So the rule states, in terms of designating people responsible for the program, the rule states that the person or persons should be knowledgeable and competent regarding FinCEN's regulatory environments and the advisor's money laundering risks, and also should have full responsibility and authority to develop and enforce appropriate policies and procedures to address those risks. So whether the compliance officer is a dedicated full-time person on bank secrecy compliance, it would depend on the size and the type of advisory services provided and the clients that are being serviced as well. So personnel who have specific responsibilities under the AML program should receive more detailed and targeted training. This is specifically called out in the rule. And includes the needs for periodic updates and refresher courses. So over and above specific rule-based training, the rule specifically states that all our registered investment advisor personnel should be provided with training that facilitates a general awareness of bank secrecy requirements, money laundering issues, and money laundering risks. So it's specifically saying that everyone in the organization, as appropriate, should be generally aware of those risks and procedures that are in place to mitigate those risks. Specifically also called out is procedures that facilitate communication between and sufficient coordination amongst personnel so that the chance of missing any red flags is significantly decreased. So basically, it's not just enough that people are siloed and have the right training. There has to be processes in place so that people can communicate between departments to make sure they coordinate their response to any suspicious activity. And finally, the rule alludes to strengthening KYC or customer due diligence procedures. So, especially in light of the increased awareness and the new rules surrounding underlying beneficial ownership, the emphasis on KYC is becoming more and more evident. So I'm going to talk about underlying beneficial ownership a little bit later, but in general, strengthening KYC processes should be part of any training regimen. So just a few other things that I wanted to touch on that affect or that relate to what's going on with AML training and the regulatory authorities looking at it. The Panama Papers was something that sort of accelerated, if you like, the whole process here in the States of requiring people to have better AML training and processes. So, the Panama Papers, as everyone I'm sure is aware, refers to the 11.5 documents which were leaked, detailing financial and attorney-client information for more than 200,000 offshore entities, and it belonged to the Panamanian law firm and corporate service provider Mossack Fonseca. The general effect of that has been the call for increased regulatory oversight and enforcement activity with respect to the types of tax avoidance and money laundering activities detailed in those papers. So more specifically, the Europeans announced tightening of the European Union's anti-money laundering rules and increased transparency requirements for companies and trusts, putting the financing of terrorism, tax evasion in its crosshairs. It specifically credited the scandal with helping, quote, focus minds and speed up this work, close quotes. The EU Parliament formed a committee of inquiry into money laundering, tax avoidance and tax evasion, known as the PANA Committee, to investigate these issues and develop reforms. So in the US, advisors such as Deloitte and some of the other big consulting firms are reporting that a large number of institutions fully expect global enforcement of anti-corruption, anti-fraud, and anti-money laundering and sanctions regulations to increase as a result of the Panama Papers. Another result of those papers has been that certain financial transparency advocacy groups have urged the US Treasury's Department anti-money laundering unit to finalize these AML investment advisor rules. So arguing that the Panama Papers and what they revealed underscores the urgency for such rules to help combat financial crime. So a lot of organizations came out and said, look what the Panama Papers revealed, all the more reason to get these rules for financial advisors finalized as quickly as possible. So there were already beneficial ownership rules proposed and almost finalized when the Panama Papers came out. But what the Panama Papers did was to confirm and support the need for those new rules on beneficial ownership with respect to customer due diligence requirements, and those rules are due to take effect in May 2018. They basically call for the identification of the beneficial owner of an entity based on ownership of 25% or more or control at the time the account is opened, and they use risk-based procedures that are reasonable and practicable. So although investment advisors are currently excluded from these new beneficial ownership rules, which take effect in May 2018, that may change and they may be included in those, and I'll discuss that in a second. There's been some pushback. The Investment Advisor Association is not opposed to some AML rules for advisors, but they've specifically asked the Treasury to provide exemptions for some advisors, including advisors who don't manage any client assets or who just do what they call sub-advisory work. So they basically disagree with the claim that investment advisors are a low-risk way for money launderers to enter the financial system. They argue that it's not that easy to open an account with investment advisors, and in so doing bypass the banks and broker-dealers that already have fairly well-developed and strict AML controls in place. So in other words, they're saying that through the whole process of opening an account with an investment advisor, you're already going to be subject to processes with the banks and broker-dealers. What's going to happen next? So what I do want to emphasize here is that there's a lot of talk in the current environment, especially with the Trump administration, that some regulations are going to be rolled back, etc. So investment advisors are potentially expecting a reprieve from these AML regulations because of that environment. However, most of the people who are advisors and experts in this area believe it is likely to become the law of the land, and that these rules will come into effect. The reason is that the directive to freeze and reduce regulation, specifically issued by the administration, held out certain exceptions, including emergency situations in areas implicating national security or financial matters. So that leaves FinCEN free to move forward with the AML rule. So a FinCEN spokesman said, has confirmed that the agency is still moving forward with the rule and is still evaluating the public comments that interested parties submitted, but declined to speculate on timing. He said, the next step is to draft a final rule and beyond that to work with OMB on how to proceed. So there's no indication from FinCEN that the rule might be dropped. A Bank Secrecy Act specialist at the SEC's Enforcement Division also shares the view that the rule is likely to materialise, in part because of the Trump administration's emphasis on combating terrorism, but also because it appears to be nearing the end of its development process and it's hard to stop that momentum. So broker dealers and banks have always been subject to AML regulations, and now the beneficial ownership requirements, which are kicking in on May 2018. So advisors are going to feel the impact through their associations as they work closely with these custodians, banks, and broker dealers. The whole process is an enterprise-wide environment that they work within. So the bottom line is that, you know, most experts think that these beneficial ownership requirements will inevitably be extended to investment advisors. So the takeaway from all of this is that investment advisors are going to be required to develop and implement an AML program under these rules, no later than 6 months from the effective date of the regulations that come about through the rules. So if you combine that with the likelihood that the beneficial ownership requirements may also be extended to investment advisors, most people consider that investment advisors should consider getting a head start on their AML programs. And one way they can do that is with some basic training. So with that, I just wanted to show you a few screenshots from our AML, our sort of general AML course that we offer in the US. These courses are scenario-based, as you see from here, and generally provide a good overview of anti-money laundering, what people's obligations are in general, who's responsible for what regulatory agencies are the ones providing the oversight. And they're generally very interactive and engaging, and generally would satisfy at a high level people's training obligations in this area. And we think they're a great way to get started for these investment advisors or anyone else who's looking for a general course as a way of getting ahead of this process. So the other section that I want to cover today for people is talking about tailoring a program to the specific needs of a business. So a lot of, you know, what we talked about earlier, you know, the rules and the regulatory bodies themselves indicate that a compliance training program should be tailored to meet the needs of the business and as appropriate. So I want to give a couple of different specific examples where the regulatory authorities specifically call for or contemplate the need for a tailored program. So let's go back to the new AML rules for investment advisors. So FinCEN recognizes that different types of advisors may present varying degrees of money laundering and terrorist financing risk, and therefore the approach to establishing an AML program should be risk-based. This is intended to give investment advisors the flexibility to design their programs to meet the specific risks of the advisory services they provide and the clients they advise. So registered investment advisors should consider a number of factors that affect the risk levels of money laundering and terrorist financing, such as their investor-based profile, the involvement of third parties, the jurisdiction of residents and organization, applicable regulatory and statutory regimes, and the type of corporate entity. So specifically with respect to training, the rule says the nature, scope, and frequency of the investment advisor's training program should be determined by the responsibilities of the employees and the extent to which their functions bring them in contact with Bank Secrecy Act requirements or possibly money laundering activity. Consequently, the training program should provide a general awareness of overall Bank Secrecy Act requirements and money laundering issues, as well as more job-specific guidance regarding particular employees' roles and functions in the AML program. So the rule specifically recognizes that training should be tailored for different people, for different situations and different business activities. So in addition, we talked about the underlying beneficial ownership rules which come into play in May 2018. Again, they also apply a risk-based approach. Specifically, the AML program requirement for each category of covered financial institutions is being amended by these rules to explicitly include risk-based procedures for conducting ongoing customer due diligence, to include understanding the nature and purpose of customer relationships for the purposes of developing a customer risk profile. So they specifically recognize that different processes have to be in place for different activities and different types of clients. So the rules specifically recognize and account for the costs of associated with designing and conducting training of employees, as well as the cost of financial institutions of employees' time spent in training. Again, implicitly recognizing the need for custom training to be created as needed. So there's a couple of different ways that you can tailor programs with respect to training. The first is content creation. So that what I mean by that is specifically creating different courses or multiple courses to address specific needs, such as role-based training or subject matter specific training with differing degrees of depth. Examples of this may include different courses for staff with client-facing duties or otherwise, or account opening duties, or access to funds transfer operations. The other way is through adaptive learning, and this is something that GRC Solutions specializes in, adaptive learning. So I'm talking about here two types, or two elements of adaptive learning that could be used here to implement a tailored program. So the first is what I'd call branching. So an institution can create a program whereby responses to questions can lead to different sections of a course, for example. As an example, you might have a course where the employee self-identifies as to what their role is, or the geography, or things like that. And in response, the adaptive course will take these people down a certain branch and expose them to certain training materials as appropriate. That's one way to do it. Another adaptive learning capability is what we would call test out. So test out capabilities in an adaptive course can be used to determine whether an employee needs comprehensive training each year or simply a refresher course. So that means you can take the employee through a series of test questions to determine their level of knowledge in an area and direct them accordingly. Either allow them to skip, the more detailed course that follows, or test that follows, or have to go through it. So basically, the rules that are embedded in the adaptive learning can determine whether the employees demonstrated sufficient knowledge to proceed. And what a lot of institutions like to do is apply these test out capabilities to employees in particular who have a higher opportunity cost. So employees where their time is more valuable than others are subject to these test out processes. So GRC specializes in producing all of the above, specializes in producing tailored content, adaptive and non-adaptive. And what sets us apart, I think, from a lot of other providers is just the amount of experience we have in developing tailored content for clients. Just to give you a couple of examples, there's a couple of examples on the screen you'll see that are sort of generic versions of tailored material we've developed for clients in response to certain things. So these might have been in response to certain specific subject matter areas that were more important to the client, certain roles that people are playing in particular, where the training has to be tailored to their particular job responsibilities, certain training that's tailored towards specific geographies, for example, that the particular employee is working with, or just generally to tailor the approach to the way the organization wants to operate, if it wants to operate differently from other organizations in the same area. So just a few examples there of where we've been able to tailor content specifically for a client. And we spoke a little bit about adaptive. Just want to show you how we're able to set up pre-tests and, explain to people what's going to happen. And the adaptive learning can branch in the direction that it needs to, based on people's demonstration of their knowledge, sufficiency or otherwise. So at this point, I want to hand over to Sam. He's going to talk about cyber security and money laundering and how those are connected. Sam, I'm just going to stop sharing my screen, and I think you should be able to share yours.
Yeah, let me just get in and do that now, and start sharing my screen so everyone can see. Okay, so hopefully, and Matt, give me a shout if you can't, but hopefully everybody here can see my screen, which has got a header at the top of cybercrime and money laundering. And I wanted to look at this from the perspective of some of the recent changes we've seen from the business case. I would start by saying that I think cybercrime is a much broader and more complex area than a lot of people make the assumption that it is. And what I mean by that is it means many things to many different people. So when we look at cybercrime, cybersecurity, digital fraud, that can mean all sorts of different things when we go from one organization to another. So it's very hard to put one thing together that adequately sums up what cybercrime is. There's also a bit of a difference and a linkage as well between cybercrime and money laundering. So cybercrime can be used in various different ways with regards to money laundering and, of course, terrorist financing, but we'll focus on the ML side today. Firstly, for actually conducting predicate offences, which would give rise to the secondary offence of laundering money, but also for the offence of moving previously laundered funds. So people can use cyber activity to launder funds, as well as to engage in criminal conduct directly using cyber methods. This opening quote is actually from the Eurasian Group on Money Laundering from 2014. And what's interesting here is they looked at typologies around cybercrime and anti-money laundering. I think this quote really sums it up pretty nicely in terms of the sophistication we see and generally, to be honest, expect now from people that are criminals, organized criminals particularly, in areas of involving money laundering and including that cybercrime. The days of traditional placement, layering, and integration, criminals conducting, drug deals and then turning up at a bank with structured deposits in the sense of breaking them into smaller amounts, are in most cases pretty much behind us. People are much more sophisticated. So as you can see in the statement here, they tend to be well educated, technically competent. They often have far superior skills to those of us working in the industry, and of course to people like regulators. They typically are well funded, and so they can use complex methods which are unconventional, hard to track, hard to detect, and also difficult from the business perspective to see when they might be occurring. One of the issues, and we'll see this in a case shortly, we haven't seen these things before, so we don't know to look out for them. Traditional defenses on the cyber side have focused on really, I guess, the fundamental side of it. So we've focused on not getting hacked or having phishing or malware issues. So nearly every computer you come across now in business will have things like antivirus, protection in one form or another. These are not the sort of things we're suffering from now, by and large. We're looking at much, much more sophisticated actors coming out with issues, both on the criminal side, the hacking side, and of course insiders. So current, former employees, contractors, business partners. We've seen issues with people, for example, leaking information, leaving security access cards. So in some places we have the sort of dongles, so a little key fob that you should take with you, but if they're left at a desk, they can provide access for systems, and people changing basic information, including email addresses, to get access to certain secure areas. Carelessness, of course, provides a big avenue for problems. The more information we leave lying around, the more carefree and lax we tend to be with our attitude around information and data, the more chance there is of things being misused. And again, we've seen that in a number of cases. There are, of course, two different sides of this. There are those employees who are actively committing willful wrongdoing, which is one thing where they are helping from the inside, and then there is just negligence. Again, what we've seen from the money laundering perspective in a number of cases, including a fine actually that came out in Singapore just 2 weeks ago for two different banks, was fines for effectively just making mistakes. So we're not fining people for egregious wrongdoing, but for not doing enough to prevent issues from occurring in the first place. We're now looking at this, or we should be looking at this, as things like cyber insider threats as one bigger risk. We need to have a look at detection, investigation, and prevention. Of course, this is a circle in many respects, and the better job we can do on the prevention side, part of that coming back to that focus that Matt was talking about on the training, the education, the awareness amongst employees, the easier things become on detection and, of course, for our investigation. This data comes from a survey that came out pretty recently from EY. So this is the Asia Pacific Fraud Survey. Now, this survey focuses, of course, on the Asia region, but is a pretty useful survey for looking at generally how trends are developing. And of course, now with cyber being such a big area, this has become a much bigger focus. I won't go through this too extensively in the sense that this information is available from or is available online, but there are some sort of key things you can look out for in terms of principal methods that people would use to launder the proceeds of cybercrime. And a lot of these you would recognize as being the sort of things people would do across many areas of financial services. So, for example, using fictitious companies, documentation that has issues, so missing or changed names, missing things like nominee shareholders, for example. Again, I mentioned remote access, carrying out financial transactions with different bank accounts. So these are some of the things we could look out for in terms of issues that arise. And one of the things we always point out to clients is who is in a position to spot these types of things happening. Not always, but in many cases, in lots of the types of business we deal with, for example, broker dealers, investment advisors, we're looking at frontline staff who are in the best place to spot some of these issues. They are also, by and large, and this isn't true always, but by and large, one of the weakest links in the chain, in the sense that they are the least able, from the point of view of being trained and made aware of these issues, and the least incentivized. And their incentive structure typically is focused on sales and commission structures, not on spotting cybercrime. So we've got a double issue to deal with there, and it's something we really need to start focusing on broadly in financial services if things are to change. In terms of where we are at the moment, and this survey we're looking at was actually focused on Europe and came out earlier last week from LexisNexis Risk, one of the divisions here. This is the Future Financial Crime Survey. I'll show two slides here that show the same stats but in a slightly different format. And the reason we have this one here, this is looking at the biggest single financial crime risk to organizations. And this is focused on the financial crime side, so finance companies, looking primarily at larger retail and wholesale banks. In the next 12 months, the first biggest threat here, 41% of people evolving criminal methodologies. So by far outstripping every other issue. So even the cost of AML compliance, which we nearly always see in the top 3 or 5 of issues around regulatory compliance burden for organizations. Here it's number 2, but it's completely outstripped by that criminal methodology change. And one of the reasons, and one of the things that's included in here, as you can see on the right, is cybercrime. So the methodologies, the way people are doing it. And again, this comes back to partly that element of you don't know what you don't know. Just because we haven't had this issue before doesn't mean it won't happen at some point in the future. And we've seen that attitude fall apart numerous times recently. Of course, the financial crisis being a shining example of that. A good friend of mine that works in this region in cybersecurity, he has something he likes to say, and I think this is pretty common amongst that industry. You know, there are only 2 types of organizations. There are organizations that have been hacked, and there are organizations that don't know they've been hacked. And I think that's quite an interesting way of looking at it, you know, from the point of view of data protection and cyber breaches. With that in mind, we've got 41% of organizations saying that they think the financial crime risk, the biggest growth area, will be those evolving challenges, including things like cybercrime. You know, how ready are we to protect our business? And the answer in most cases is not particularly ready. This chart here gives a great example of that. So if we look at the right-hand side, 39% of organizations feel prepared to deal with a specific threat from a cybercrime event, but 53% of banks think they are only somewhat prepared and 8 underprepared. So really, we've got staggering statistics here. You know, on the one hand, we've got compliance professionals telling us they think this is the biggest risk they'll face in the next year. And then on the other hand, telling us they're also not preparing for this risk, which, you know, is sort of counterintuitive. We know this is happening. We know this is an issue. We need to be looking into this in significantly greater detail. One of the things I've noticed in the last, particularly the last 6 months, but the last year or so, is that the industry is finally, I think for the better, changing and moving away from a quantity approach into more of an output-driven approach. And partly that's been driven by the risk-based approach to business, where we're looking at real positive outcomes and output from business decisions instead of throwing numbers at problems. As an example, if we go back to 2012 to 2015, every time an organization was in trouble for regulatory breach, the instant response was to hire people, just throw numbers at the problem. And that has been, by and large, an ineffective response. It hasn't solved a lot of the problems that people were dealing with. We're now looking at using things like more sophisticated tools and technology. For example, Matt talking earlier about things like adaptive learning instead of traditional approaches, to try and do these things in a bit more of a streamlined, efficient manner that actually provide a business benefit, not just something that looks good on the PR side. Towards the end of last year, we had an advisory from FinCEN looking at financial institutions, so on both cyber events and cyber-enabled crime. And the large bulk of this focused primarily on the filing or the need to file and the protocols around suspicious activity reports. So this was a document that outlined a number of things that organizations need to be doing, and really that the need to be filing reports and the elements around what would constitute suspicion were very heavy in this document. As is typical with nearly all regulatory change developments, and the same with, in many cases, aspects of law, this came in response to a number of events, but one in particular that we'll look at in a moment, so a case study from the last couple of years. So looking at significant threats to consumers and to the financial system. This is a bigger problem for people. We have a very, very broad range of financial literacy in most jurisdictions. And what I mean by that is we have those that work on the inside of finance and financial services who are very well versed in what products mean, how things are structured, how things work, and then the rest of the population, particularly those in the moving towards retirement age, who have a much lower level of financial sophistication and form much easier targets for prey from people committing wrongdoing. This advisory looked at the BSA and looked at reporting for combating cyber crime, cyber events, and looked at, as I said, reporting through SARs, including relevant information in those reports. So, for example, IP addresses, internet protocol, timestamps, virtual wallet information, so looking at things including virtual currencies, the use of things like Bitcoin and the blockchain digital ledger technology in those SARs. Also, the collaboration between AML and BSA units. And what came out with a couple of other reviews following this document was that the general consensus was they should work incredibly closely together, but they should not be combined. So the sort of feeling amongst industry broadly was it's a good idea to have them working almost hand in hand, but there should be a separation between the units that look at cybersecurity and the unit that looks specifically at AML activity. And of course, the sharing of information where available, where applicable, and where legal, including cyber information amongst institutions. So the more we can do between firm A and firm B, the more we can look potentially to prevent issues happening across the system more broadly. I mentioned a case earlier, and this is a case that sprang to light over the last couple of years. So really, primarily about a year ago, so early 2016, one of the biggest bank heists we've ever seen, a phenomenal piece of work in many respects, committed by an unknown group as yet, but suspected to be not a particularly big group, so circa 4 or 5 people, with what looks like potentially inside help at the Bank of Bangladesh. Now, the reason this is important is the sheer number of jurisdictions involved. So this happened with the Bank of Bangladesh using or hacking into the SWIFT messaging network. And this was in a period of time where that particular technology was under threat on the cyber side from a number of areas. And after this came to light, SWIFT announced there'd actually been a number of other relatively major breaches. The Bangladesh Central Bank used the Federal Reserve in New York for depositing their information, and this hack took place over a long weekend. So these guys knew what they were doing. They planned it pretty well, knowing that when the Bank of Bangladesh contacted the Federal Reserve in New York, there wouldn't be anybody there because it was a long weekend and they were on holiday, giving them extra time to inflict their misery. Now, it's not entirely known what happened here, partly because whilst the Bangladesh Central Bank has investigated, they've refused to release the report publicly, even to the Philippines, where a lot of this money ended up. So the vast bulk of this money went to the Philippines, with some going to Sri Lanka, and ended up in a casino in the Philippines, where most of it has since vanished. So around $81 million of this has ceased to exist, apparently. The same day, the money got wired to a bank in the Philippines, so a bank called RCBC. The branch manager of that bank, a lady, she got on a plane, or attempted to get on a plane in the Philippines, where she was apprehended at the airport, which obviously looks mildly suspicious and not great for her potential future. So this is a major case of action that took place pretty quickly. So in the space of just over a day, these guys attempted to transfer $1 billion out of the foreign reserves of the Central Bank of Bangladesh, using relatively simple information, so changing information in codes encrypted with SWIFT messages. This is a pretty good graphic here that shows where the trail went, and this is from an article in Reuters towards May of last year. And you can see what happens here. Now, some of the orders were blocked, primarily because of bad spelling. So a couple of the orders that were amended, the spelling mistakes were picked up by actually one of the routing banks, which was Deutsche Bank, and the system automatically blocked them. They got away with 101 million. 20 million was then blocked with a misspelled name of that NGO, and then 81 million went to different accounts in the Philippines, from where most of it ended up in casinos and has seemingly vanished. Now, Bangladeshi officials have been to the Philippines to try and recover their money. Thus far, they seem to have been particularly unsuccessful in that regard, and the cooperation between those two nations on this front has been, I would suggest to say, not the best thus far. Shortly afterwards, as this sort of news and this story continued developing, the Federal Reserve of New York said that they had worries about issues, so particularly to do with lax security procedures at some of the foreign central banks that were customers. Now, SWIFT, the messaging organization, which is of course an interbank grouping, their view on this was it was very much an issue at the client side. It was not a problem on the SWIFT system side. It was a problem on the client front. The New York Fed was concerned with lots of vulnerabilities, said a former government official, and SWIFT was one of them. However, based on them perceiving the risk to be low, resources were focused on other areas, so enforcing sanctions, preventing money laundering, for example. So taking that risk-based approach led to an issue where the SWIFT, although it was known as a potential issue, the SWIFT problem was overlooked, and the system was deemed to be sort of good enough in the sense that it had never happened before. So the system had never been hacked before, the security had never been breached, so therefore it should be okay. Of course, that then has led to somebody losing $81 million. So there's now a claim from the Bangladesh bank for payment of lost funds and a looming potential lawsuit. This also showed, and you can see here, the US central bank long understood this systemic risk, but was either unable or unwilling to address it, which is, relatively speaking, a bit of a damning indictment for a bank with the stature of the New York Fed. What does this mean then specifically for what's going to happen in our industry? How are we keeping up with things? We've seen these issues. We've seen one of the biggest attempted cybercrime ever, I would say, trying to steal $1 billion, getting away with 101 million. It's a pretty massive amount to steal from a central bank, from one group of individuals. Are we leveraging the benefits of potential technology adequately? And you can see in this chart, the answer really is, in terms of what people in the industry think, is most certainly not. So if you look at the third column here, the question is technology hasn't kept pace with cybercrime, and 81% of people think the industry is not leveraging technology benefits suitably enough. Compare that to 49% thinking that the cost is a challenge. There's a big gap here. So we're sort of saying one thing, but almost doing another. We know these problems exist. We know that we have AML threats through cybercrime. We know technologies there that can help us deal with this, and yet we're not doing that much about it. And again, the simple things like, for example, having adequate policies, procedures, processes in place, having suitable education, awareness and training for staff, and making it appropriate for the job they're doing could help. But unfortunately, in many cases, although of course not all, we're still doing the same types of things we've been doing for many, many years, even though the nature of the threat we are facing has changed very, very considerably. I wanted to finish off with a slide here that I think is particularly useful from earlier this year. And this is from the US Department of Justice. And there was actually two different documents came out in a very, very short period of time. Sorry, I've gone one step too far there. One was from the Department of Justice, and in the following month, one from the US Department of Health Inspector General, that both outlined steps or measures they would look at with regards to the evaluation of corporate compliance programs. Of course, the Department of Justice are looking at this from a corporate business perspective, the Department of Health looking at this from, of course, a medical health perspective, and there was another key difference. So the Department of Health and Human Services looked at it from an external perspective. So they were providing guidance for people in the industry to use, whereas the Department of Justice were using this primarily on the internal basis. And what I've highlighted here is training and communications. So if you look at the 11 pillars we have here for what would the DOJ say, this is what we need to have. We want to see evidence, we want to see solid data here that you've got these things in place. One of them is training and communications. And so in these areas of things like cyber offenses, cyber events, electronic threats, and links to money laundering on that front, are we adequately training our staff? Again, the days of going through placement layering integration, I think we really have to be very much moving away from that towards the current threats faced within our organization. On that note, Matt, I think I'll hand back to you for the last couple of pieces. I'll just change my screen, so I think I can stop presenting. Let me just see.
Yeah, I can do that.
Have you got back control?
I believe I do. And all right, I want to thank everyone for attending today. I'm just going to skip through to the end. Thank you, Sam. Appreciate your insight into cybersecurity and AML there. I just want to let everyone know that we'll be sending out the presentation to people. I'm sure they'll find it interesting. And if you have any questions, feel free to email us back after you receive the presentation. And if you're interested in any sort of GRC products and interested in a demo, of course, we'd be delighted to talk to you about your training requirements and how we can help meet those. So on that note, thanks everyone. Appreciate your attendance. And hope to hear from you. Thanks. Bye.